All right. Hello, everyone. My name is Ernest. I'm a co founder of TechChill. My title at the TechChill is Lorem Ipsum because I do a lot of stuff. I'm a host on the stage, I'm a board member, and I advise the team, mentor the team. And sometimes I host podcasts when I talk with interesting friends and family of TechChill people. And today I have my honor to speak with Ilya from Flashpoint. Hi, Ilya.
Hey Ernest, thanks for inviting for this podcast.
Yes, and so can you tell me a bit more what you do at the Flashpoint as a what is the fund strategy and what's your approach to investment environment?
Sure. So maybe a quick couple of words about Flashpoint. So we are a venture fund which has grown from being a pure kind of venture capital fund investing in late seed and Series A companies founded by people originating out of the region that we call emerging Europe, which essentially spans from Finland all the way through the Baltics, Central Eastern Europe, and Israel. Those companies tend to be global with some links to the kind of core region through the founders' origin and certain operations based in these countries. So we've been doing that since 2012 when we still do it with sort of a core focus on B2B SaaS companies as well as marketplaces. But over time, we've grown into something bigger than just the venture capital funds through introducing different products, and I guess some of which we'll talk in a bit more detail later today. But sort of the other products are, for example, venture debt, which I like. The venture debt fund is the one that I work in at Flashpoint, and so venture debt is an alternative type of funding available to high growth technology companies in the form of debt capital. And we do that for slightly later stage companies, usually around Series B, with the same geographical focus. And then, sort of our most recent addition in the Flashpoint product line, if you will, is our secondary fund, which looks at even later stage companies, usually around Series C and later. And as it says on the tin, it's about sort of us buying secondary shares or sort of existing shares in the company from early stage investors or sometimes founders. And the use cases are usually when the company has a very fragmented cap table or many investors. Some of them are early stage and maybe seeking some liquidity and exits. So this is when our sort of secondary fund comes into play. And that's us as Flashpoint. We are about half a billion US dollars asset under management business as of today. We're sort of more than 30 people team spread across the region. We're headquartered in London with regional offices in Riga in Latvia, in Warsaw in Poland, Budapest, Hungary. We've got an office in Cyprus. Yeah, so that's briefly about us. And as I said, I work in the venture debt fund as an associate, investment associate.
Wow, you have a pretty wide spectrum. Before we dive into more specific tools of funding, what kind of types of companies do need funding? It's not in general. It's like a lot of people have this misconception that everyone can just go and ask for money. How you view what is the typical, let's say, consumer of venture financing?
Yeah, exactly. So I think broadly, any company may need funding because it ultimately is required for growth, right? When your own cash flows are not sufficient to invest into be that product or your sales and marketing, which allow you to grow as a business, that's when you seek funding. But speaking of venture capital specifically, I think it's definitely targeting a specific subset of companies, and those companies are usually defined by explosive growth, right? So these are companies that are looking to invest heavily into developing their product and probably even more heavier in marketing and selling that product in order to achieve that 100% plus year-over-year growth, grow that business to tens if not hundreds of millions in revenues on a 5 to 10 year horizon, and what's called make an exit, right? So to sell the business, be that in an acquisition or an IPO, right? So kind of a public offering. And that's the type of companies that venture capital firms are targeting, because their business model is sort of mainly built around investing in these companies, getting a stake, and then being able to realize that stake, i.e., sell that in an exit, sort of earning a high multiple on their initial investment. So that's broadly the group of companies. And then sort of diving deeper, obviously, you have different business models and you have companies operating in different industries. And lately, the majority of the companies that have been targets for venture capitalists have been operating in the tech segment, which is highly scalable, which doesn't require usually a lot of investment into like hardware infrastructure. It's mainly software businesses. And those have also been sort of, at the top of the pile for venture capitalists.
Mm-hmm. Yeah, well, tech makes kind of sense. It's relatively low cost or less capital intensive industry with potentially big upside. So what are the so venture capital is one way to sponsor this journey. What are the other ones?
Right. So definitely, yes, venture capital is predominant source. And as I've mentioned earlier in my introduction, venture capital generally can be sort of subdivided into other different products, including debt, and we can touch on that a little more as well. But venture capital aside, obviously there are other sources of capital. One potentially being traditional debt, and that is bank debt. Unfortunately, companies operating in the venture segment and being technology companies, software companies, with not that many fixed assets that traditional banks, are used to when crediting businesses, as those go as collateral. So maybe less applicable, but definitely in certain countries that could be one of the ways to start the funding. Other than that, obviously there are agencies, European agencies like world agencies, which provide various grants and subsidies aimed at fostering the technology ecosystem, and who subsidize certain R&D activities, for example. And in Latvia, for example, we've got Altum, who have been looking at providing various grants and subsidies to technology companies. Other than that, there are tech companies, probably, again, predominantly in tech, but maybe more hardware focused areas, which sometimes go for crowdfunding, like Kickstarter, for example, which allows them to raise funding by essentially pre-selling their product, and that sort of gives them the working capital to invest into the product and development before releasing that product to the market. So that's also potentially one of the ways of raising money to kickstart and grow your business. But relative to venture capital, these types of funding are usually significantly smaller. So if you are planning to grow your business into a multi-million dollar company, then venture capital will probably be one of the key sources of funding.
Venture funding has deep pockets.
Correct.
All right. So as a founder, so let's say I'm building something. How can I figure out what kind of funding fits me?
Right. So I guess, as sort of earlier touched upon it as well, maybe drawing a line distinguishing between a lifestyle business and a growth business. So if you're a lifestyle business, in the sense that you're building a company that's delivering a great product, but that's not a business that you're aiming to sell in 5 to 10 years time, and make a living out of that, but rather have a functioning business that is growing at a certain pace. It's delivering you cash flows which you can live and further develop that business.
So that's
If you're
what could be examples of lifestyle business, like cafeteria or
correct, I mean, it could be more traditional businesses like a cafeteria or a bar, right? Or I don't know, an events agency, for example. But it may well be a software company that develops a certain software product and sells it to the market, as well as, I don't know, IT services, for example. But it's more about what's the goal of the founder, right? Does he want to maintain that business and grow it over his lifetime, and sort of be that his main activity, right, and main source of wealth, if you will, versus actually building a company in a high growth and then selling it. So I think that's essentially the distinction, rather than necessarily the type of business. But certainly some of the businesses lend themselves better to lifestyle versus that venture capital growth businesses. So if we're talking about a lifestyle business, right, you're the founder, you're the owner. Probably one of the things you care about is remaining such. And unlike venture capital funding, which often cases, especially we're talking about equity funding, comes with the cost of giving away part of that business to the investor. Things like we discussed, grants, bank debt, crowdfunding, all of those allow you to keep your equity in hand, right, and remain kind of the controlling shareholder of the business.
so
Um,
so when you go venture track, that means that you are not alone in your company and that you have given up some control, and basically there will be some sort of an exit at some point.
Correct. That's what you'd be targeting. Obviously, it comes with massive benefits as well, because if you're taking on board a venture capital fund as an investor and as a partner, these are usually institutional investors with portfolios of companies with a track record and experience of investing in these types of businesses, who have connections in the industry, so beyond venture capital, but connections in the industry that you're running your business in, and who can support and will support you along your growth journey, because it's as much in their interest to grow the business as in yours. So yes, you will be giving away parts of the business. You will have people who will join your board of directors, serving as a sounding board, yes, but obviously you need to realize that there will be other people who will also be involved in the decision making, and you need to accept that.
So there's equity financing and the venture debt. What's the difference?
Right. So I guess venture debt is that part of venture capital that allows you to minimize the effect of that giving away of parts of the business and parts of that control. So to maybe double click on venture debt, definitely not an alternative to equity funding, but rather a complement. So what is venture debt? Venture debt essentially is a loan that is given to a company, right, or a technology startup, that in many ways actually resembles a mortgage, but just a much shorter duration mortgage. Usually it's around 3 to 4 years. And when I say it resembles a mortgage, it means that one, it has to be fully repaid. So not to be confused with, for example, a convertible loan, which essentially is a type of equity capital or quasi-equity capital, which legally and structurally is a form of debt, but never meant to be repaid, or in most cases, it's not meant to be repaid. And there are various scenarios upon which it converts into equity at a certain point in time in the future, linked to the next equity round, or at some point reaching a maturity. So venture debt is fully repaid as a traditional loan. It's repaid usually on a monthly basis in equal installments, again, very similar to a mortgage. And that payment includes the amortization of the actual principal, meaning you're repaying the loan, as well as paying the interest on that loan. And the third way in which it's similar to a mortgage, it comes as a secured loan, meaning there are assets in your business that are pledged as security to essentially guarantee that loan.
What could be the assets?
Right. So if we're talking about, again, technology businesses, software businesses, there are not many fixed assets, right? And that's where we differentiate ourselves from banks who are not comfortable or just don't know how to lend to these companies because there are no fixed assets. We, on the other hand, being a venture fund at the end of the day, we understand the value in these businesses, and assets do not necessarily have to be tangible, right? There are some assets in like software as a service companies, like receivables, for example, which would be an asset. But more importantly, it's the IP, right, intellectual property that the company has developed over time along with its product. And that's normally, the main kind of the main assets that we pledge. And we can sort of argue about that having monetary value or not at a certain point in time. But quite critically, it is the core of the company, and it is what serves as as security to us.
So you mentioned receivables. So basically, it's I can raise venture debt against my potential revenue.
Well, there again, there are sort of other ways of or other sources of debt funding popping up now and becoming more popular, which we can also touch upon. But with venture debt, having receivables is, for us as a lender, is an understanding that the company sold a product and there is going to be a continuous stream of cash flows of a certain quality, and that can support the payments or repayment of the debt, right? So it's not necessarily tied to those receivables, but that's just one of the assets that can give us comfort that there is cash flow in the business that can be used to service the loan.
What are the other debt funding or funding types similar
Right.
to
So
this?
yeah. So for example, like you touched upon receivables. So um, you may know that there are companies in Europe and across the world that are gaining popularity, and I think that generally they're sort of called revenue-based financing. And again, it has multiple subsegments of that, but I think the general characteristic that kind of defines them is they actually lend against your revenues or your receivables, and they come in various forms. Some companies, like traditional revenue-based financing, they lend you a certain multiple of your monthly recurring revenues or ARR, and then they define a percentage of your monthly revenues that are used to pay back that loan. Some companies just buy your receivables essentially at a discount and tell you, okay, you've got 1 million of receivables. We're going to give you 800K of cash up front, but then you'll repay that million sort of back to us, or you'll channel the 1 million of receivables to us over the next year, if that's your receivables for the next 12 months. So that's another way of looking at it. And these are the types of other forms of debt financing that are available. They're different from venture debt because they're usually a lot shorter in duration. As I mentioned, they're usually within 6 months to a year maturity, meaning you have to repay the loan earlier. And an example that I gave you is actually quite real in terms of the discount that you would get on your receivables or revenue. You can easily, get a 20% discount on your receivables, repaying that over a year, which would actually result in quite a high cost of capital. So companies that have very quick receivable cycles sometimes use it to finance their working capital. But if you're looking for an investment that gives you more runway and allows you to sort of better utilize the cash over the longer term and invest that into growth, that's sort of when venture debt is more applicable, I would say.
So, on a more practical side, which are the companies at what stage, size, financial situation who would be applicable to venture debt, and what is the amount of money I could raise as a company in this type of financing?
So, given that the debt industry, especially for the startups, right? So the various forms of debt capital for technology companies is maturing. I think the spectrum of the companies that can raise that debt capital is also widening. Normally, you would see smaller companies with, tens of thousands, maybe in monthly recurring revenue, raising something similar to a revenue-based financing facility, because those are normally sub $1 million. Again, there are companies that can provide larger checks and look at larger companies with the same debt repayment model, but predominantly sort of that. I think that product has found its niche in earlier stage companies. So I would call them pre-series A, right? Or companies that have, I don't know, 10, 20, 50,000 euros or dollars in monthly recurring revenues. We're talking about a SaaS business. If we're talking specifically about venture debt, those are normally companies that are beyond Series A and usually have north of 200,000 in monthly recurring revenues or monthly net revenues, depending on the business model. And those are the companies that we would be looking at. And again, the tickets that we write range between 1 to 5 million. Usually, we can go more, but then that scales with the size of the business. And specifically for venture debt, one of the factors that affect kind of our decision and the amount of money that we can invest is the VC, like traditional equity venture capital investors in the company, as they also serve as a certain safety cushion for debt, right? Because they are the equity sponsors that inject cash into the company and they provide that growth capital.
So that means that if I don't have investors, I'm not applicable.
I would say for traditional venture debt, less likely. However, again, that also depends on other factors. For example, some companies can be profitable, right? And we can assess those companies as, I would say, profitable enough and have a sufficient stream of net cash flows that would allow it to repay the debt. What's important and probably of paramount importance is that as we call it, the engine of the company or the unit economics of the business are sound, and that would allow you to generate those cash flows to repay the debt. So we do see profitable companies with maybe no institutional investors, like your venture capital funds, who would be seeking venture debt and actually getting venture debt because of the profitable business model that they have, and we have enough confidence that there is enough cash to service that loan. Because again, if you think about traditional growth technology startups, usually they would be heavily EBITDA negative, meaning they'd be burning cash to grow. But what's important to understand there is, one, that growth is eventually profitable. And if there is time needed to get to that profitability, then there are financial sponsors or partners in the company who can support it in a rainy day.
So, in a way, you become alternative to bridge rounds or unnecessary next raising round. But it could be, rather than previously you would go and ask for a bridge round or try to extend the runway, now you have this tool available.
Yeah, so one should be cautious about seeing venture debt as a purely bridge instrument, because what you don't want to do is to take on debt when you don't have any other
Yeah.
sources of capital, right? So you couldn't raise equity money. You're running out of cash, and your runway is short, and then you're looking at venture debt or debt in general as an alternative form of funding, or like the lender of or funder of last resort. That certainly doesn't work that way, right?
Yeah.
But naturally, one of the ways where venture debt is helpful is in those bridge situations, and those bridge situations I would define them as the company has raised cash, I don't know, maybe like 6, 9, maximum probably like 12 months ago, and still has about a year of runway. But within that year, you have enough visibility to understand where can you get to with that money that you have today, right? I don't know, maybe you've hit a soft quarter, or as a startup, you're obviously experimenting with sales and marketing channels, products. Something maybe hasn't gone exactly to plan, and you understand that in order to reach a certain milestone, which often is defined as a certain revenue threshold to raise your next round, you could well do with another quarter of two of runway. Or sometimes you're just anticipating difficulties, or you just want to ensure that whatever happens, you have enough cash runway to deliver on that. That's when you can go for venture debt. And obviously, the major benefit of debt versus equity is dilution, right? So with debt capital, you're not diluting yourself. So that allows you to raise that additional money without giving away more parts of the business at the valuation that you have currently, and rather get to that higher revenue number, better multiple, get a higher valuation eventually in those 18 months, and raise your next round on much more favorable terms.
Yeah,
So that's definitely.
that was the way how I looked at it. That sometimes you are forced to raise new round because you could go a bit longer and have much better terms, because there are some things coming ahead. Maybe season is there, maybe you just launched something and you just need this 6 months or the runway extended just to reach better condition of the company, where you can have much better situation to raise next fund. And this fills that gap where previously, well, you need money now. So
Exactly, and I mean also that's obviously one of the scenarios where companies raise venture debt, but one of the other predominant cases is actually companies raising a round which consists of both equity and debt capital. The purpose is similar, that you minimize the dilution. For example, instead of raising 5 million in pure equity capital, you can raise, for example, 3 million in equity and 2 million in debt, right? And that way you're effectively minimizing the cost of capital through minimizing your dilution. And that happens oftentimes, and usually that is the best time to raise venture debt, as having that fresh equity investors gives a lot more comfort to us as venture debt investors, and we can be more flexible and generous on the terms because our risk is minimized at that point.
so what you're saying is that you can reduce cost of capital rather than giving up big chunk of shares. You can give up smaller part of the pie but still get the money, except now you have now you have given up
Exactly.
less shares, so it's more cost effective on the founder's side to look into
Exactly.
this.
Exactly. Founders and also existing investors, because they're in the same way shareholders of the business as the founders are. Correct.
So as a founder, how can I figure out which way should I go?
Right. So again, as I mentioned previously, I don't think equity versus debt is a binary decision where you have to choose either one or the other. The best is a combination of both, and usually what we see, I wouldn't call it a rule of thumb, but generally, that's how factors tend to play out. Is that your debt raise corresponds to about a third of your total money raised. That's probably a good balance, which gives kind of you the benefits of venture debt in reducing dilution. It gives the venture debt investor sufficient comfort that there is a healthy equity cushion that in a way secures that debt and leads to a more favorable debt deal. But ultimately, when choosing between debt or equity, or at least understanding what portion of debt would bring you in terms of the reduction in that cost of capital, I guess it's important to understand, right, how do you define that cost of capital and how do you calculate it in order to be able to compare the various offerings, whether you're comparing, raising an incremental amount in equity or debt, or comparing the various forms of debt, then you do need to think in terms of cost of capital. And the way we think about it, and probably the uniform way of thinking about it, is to think in terms of IRR, so your internal rate of return, or your annualized cost of capital. And I guess one of the ways to think about it when, for example, comparing incremental equity or debt is to kind of think of the following way. So if you're raising an incremental 1 million of equity capital, for example, I don't know, like let's say you're giving away 10% of equity with that. That's your valuation. In 5 years' time, for example, you have an exit and your company has increased in its value by 10 times. Essentially, that 1 million that you've taken has turned into 10 million, right? And the cost for you is 9 million, essentially, because that's the amount of value you've given away with that 10% stake, which could have remained with the company and amongst the shareholders. If you're taking debt capital, and let's speak about venture debt in particular, usually for 1 million of debt that you raise, you would get, at the end of the 3-year term of the loan, you would return about 1.2 times of that million, together with all the interest and fees that you would pay. So that's broadly the cost of venture debt capital. And then in addition to that, and this is something we haven't touched upon, but the other part of venture debt is a small equity kicker or an equity component, which comes in the form of a warrant, which is nothing more than an option for us as a lender to buy equity in the company, right? And it's usually 10 to 15% of the amount. So if we're talking about a 1 million loan, we would get a 150,000, an option to buy 150,000 euros of equity in the company. Again, we wouldn't get it for free. It would be essentially a cash exchange, right? We give you 150K, you give us sort of whatever is the amount of equity that we get or shares that we get for that amount. But because it's only 10 to 15% of that million, your company grows to 10 times. Okay, it used to be 150,000 and turned into 1 million, for example. So your total cost with the warrant and debt would be 2 million. Your cost of equity, as we defined, would be 9 million. Sorry. And then obviously 9 million happens much later, but debt, you do have to pay, your interest and principal back over those 3 years. So cash flows are different. So if you were to build, an Excel with a string of cash flows for both of these examples, right? So you take in the equity and you take in the debt today. With equity, you'd have like a long blank until year 5 where you have an exit, and that's essentially where you're giving away that stake, which is sold. With venture debt, you would have that string of repayments and then that warrant being realized and the additional million from the warrant. So if you'd build that, with venture debt, people are usually looking for somewhere around 20% in IRR, whereas venture capitalists, they look at 50, 60, 100, right? So this would sort of allow you to compare like for like your equity versus debt, or if you have various offers of debt capital, then you can build those strings of cash flows in the same way and understand what is the difference in your cost of capital. As I've explained with some of the revenue-based financing options, yes, some companies may come and tell you, look, we'll buy your receivables at a 15% discount. So you naturally think, oh, it's a 15% cost of capital. So it's cheaper than, I don't know, let's say 20% of venture debt. But then if you actually build a thing in cash flows and realize that you're repaying that principal every month with sort of interest, and covering that 20% discount, you're actually ending up paying a 40% IRR in that facility. So you really need to be comparing likes for likes.
Yeah.
And that's sort of one of the ways you can think about it.
Yeah, usually when the compound and percentage comes in, then it becomes a bit more tricky. But founders should know that.
Exactly, yes. So again, those are all different types of funding, both within the debt category and more broadly. But these are the ways how you can think about it. The example I gave, I compared it in terms of millions, so you can understand. Okay, with debt, it cost me 2. Eventually, with equity, it cost me 9. But when you have sort of various different forms of capital with various maturities, then it becomes tricky, and then you do want to look at something that's uniform. Like when you go to a supermarket, right? And I don't know, you've got 2 packs of tomatoes. One is bigger than the other, and they have different prices. You're like, okay, which one is better for me? And then usually somewhere in the corner you have the price per kilogram.
Yeah,
So that's
yeah,
essentially
yeah.
that's essentially what IRR tells you, right? Is it's all bringing it down to the same denominator and comparing the cost of capital, the like for
So
like.
this is a different way of financing. How popular it is in our region, like let's say Baltics and Finland, which are the closest neighbors.
So definitely debt funding and venture debt in particular is only gaining traction in our region. It's been founded and sort of first tried and tested in the US, and now it's become a very developed market where statistics says about sort of every fifth company that raised venture capital money at some point raised venture debt. In Europe, in Western Europe, we see that number sort of closer to 5% maybe. In Eastern Europe, it's almost non-existent, right? And partially because there are not many funds that are offering it, and we're definitely
Exactly.
one of the exclusive companies that actually provide debt funding locally, right? And the reason it's also less developed in our region is because, unlike the United States, where you have a massive market with generally the same federal regulation and legal framework that allows you to do the same venture debt deal in New York or California, in Eastern Europe, right, or the Baltics or Finland, in every single country, you would have different legislation and different legal framework that requires the lender to adjust to those. And since we've been active in this region and we've been looking at these countries for over 10 years now, we're comfortable with these legal frameworks. We understand them. We've got the in-house expertise, which allows us to do it. But not many people have the same level of expertise, so they just don't go here. So it's both a function of penetration of the funds and having that availability of capital, as well as, and as a result of that, the broad awareness of our local market of such products. Hence, it hasn't been, very popular, but it's definitely gaining traction, and I would like to think that we're contributing to that by having sessions like this where we can talk about these forms of capital and fundraising in general to give people better understanding and maybe some thoughts and instruments to be able to compare and choose these instruments when they're relevant.
So, in conclusion, you're going to be at TechChill. So, where
Yes.
and how people can meet you?
Well, I am going to be a TechChill, so definitely if you bump into me, if you recognize my face, I'm always more than happy to talk to you. Obviously, you can reach out to me on LinkedIn. I'm sure you can find my email somewhere around our website or smart people have the tools to figure it out anyways.
Somewhere
But
in
if
description.
anything, if that's possible, we can put it in the description. It's Ilya at flashpointvc.com. More than happy to hear from you guys. And I think we've always been saying, even if the company is too early for venture debt or something, may not necessarily be ready to take on debt funding, we're still more than happy to build that relationship, because at the end of the day, it's a relationship business, and we are going to be partners for a certain period of time if that investment happens. So relationship is super important. But again, also our goal here is to educate the market and give people a better understanding of the product. So we're more than happy to chat and tell you more about it, look at the company, suggest what's working, what's not, what needs to be done to make the company debt ready, so to say.
So thank you, Ilya, and see you and hopefully our listeners at TechChill 2022, the first in-person event for a change after the big long COVID years. TechChill, who doesn't know yet, happens from 27th till the 29th of April. This time it's April, not February, as it used to happen. So, thank you everyone, and see you at TechChill.